We all know that this is a hot sector right now. 15 years ago, investment volume in the sector was about 1 billion euro a year. Now it's about 30 billion euro, constituting around about 11% of commercial property. Occupancy remains strong as well. Most of the larger investor developers have never seen higher occupancies. From the investment standpoint, the year has been absolutely remarkable. The platform transactions that we've seen this year have really set a new benchmark. And just to put it into perspective, the three largest transactions that have happened this year, so the Logicor transaction, the P3 transaction, and most recently, the Gaisley transaction that was announced last week. Together, these three transactions within about the past year constituted 17 billion euro of investment volume. Just three deals. Now, to illustrate what that means, 17 billion euro of investment volume is roughly equivalent to all commercial real estate investment in Portugal, and also Denmark, and also Belgium, and Poland as well. So 4 European countries are roughly equal to the transaction volume from 3 individual deals in the logistics space this year. With that, clearly, some of the most sophisticated and smartest international investors and sovereign funds are placing big bets on this sector, and there's some good reason why. So with that, the 3 predictions. I think firstly, putting aside e-commerce for a second, putting aside technology, the sector as it currently stands has a long way to run. Why do we think this? Because Europe remains undersupplied for logistics real estate relative to North America. Demand remains incredibly strong. A survey by Prologis estimated that the warehouse space required for e-commerce is roughly 3 times the amount required for traditional retail. So e-commerce continues to grow, supply chains continue to be reconfigured, and demand for what we see now as conventional warehouse space continues to increase and looks like it will do so for at least the medium term going forward. Observation number 2, I wouldn't call it a prediction quite yet, but maybe some way it will be, who knows. But we're all aware that there are some very profound technologies influencing this space. So just to name a few, to illustrate, 3D printing, driverless cars, automation and robotics, artificial intelligence, and structurally lower fuel costs. Any and all of these 5 technological changes can, over time, have a large impact on not just logistics real estate, but really everything. Not even real estate generally. Really, if you think about it and you play it out over the long term, taken together, every single investable asset class is going to be impacted by these technologies. And I think from our standpoint, from the logistics real estate standpoint, if you're going to put your chips on the table somewhere, you may as well pick here, because at least you're in a sector that's growing by 10 to 15% a year, one that has structurally sound customer demand and increasing absorption in most markets, and is riding a trend of increasing e-commerce throughout. So that's prediction number 2. In terms of number 3, I think when we look where we are going to be 10 years from now, the boundaries are going to continue to blur. There's always been a need for flexibility in warehousing, and usually flexibility has meant shorter lease terms and maybe a bit of expansion land. And those are the 2 parameters with which to think about flexibility. I think that will change a bit, and we'll start to see a blurring of the boundaries between logistics and other asset classes. We see it already. For example, you might see more visibility from a product standpoint into inbound containers or product in ships in harbors, for example. And on the outbound side, you might see more of the integration of logistics or warehousing components within office space, for example, or underground car parks that are repositioned, et cetera, retail parks that are now better positioned for logistics, et cetera. We're starting to see this trend happening. And as we look what's going to happen going forward, we need to think that maybe logistics warehousing is bigger than just the sector as we currently envision it right now. It's absolutely a fascinating time to be here. It only gets more so every year. There's going to be some really interesting questions to think about in terms of how it impacts functional obsolescence. What constitutes functional obsolescence? What is a modern facility? How do we think about last mile, et cetera? but there's no better 4 people to hear it from than these 4 right now. So with that, thank you very much, and delighted to turn it over. Thank you.
Great, thanks very much. So, almost no doubt about it that this will be the best panel that you attend during Expo Real. Good. No pressure, gentlemen. We have a fantastic panel, which I can't see, but I'm guessing it's probably displayed above my head. But we have Ben Bannatyne, who's president for Europe of Prologis. We also have Robert Dobrzycki, who's CEO for Panattoni Europe, Ian Warboys, who's CEO for P3 Logistic Parks, and Mo Barzegar, who's president and CEO for Logicor. So it's delightful that we've got such a junior panel with us. I mean, that's excellent. Maybe just starting, and let's start at this end, Ian. For those who don't know you, just give a brief kind of overview of yourself, the company, because you were obviously also mentioned by Logan in the first in terms of one of the deals of the year. So just give us a brief overview.
Hi there. Name's Ian Warboys. I'm the CEO of P3 Logistic Parks. We're headquartered in Prague, the Czech Republic, which I'm told is the center of the universe for distribution. That's what we tell people. And we are owners, developers and managers of 4 million square meters of our own warehouses. We operate with 8 offices and actually operate in 11 countries. We recently, the sale that Logan mentioned, we were sold for 2.4 billion from TPG and Ivanhoe Cambridge, and we were sold to GIC, our new parent company, who's continued to invest heavily through ourselves into this sector.
Okay, great. Mo.
Thank you. My name is Mo Barzegar. I'm CEO, president of Logicor. Logicor still is a portfolio company of Blackstone Group. It was founded 5 years ago. Today we own and operate a portfolio that spans about 14 million square meters. According to Green Street, Ben, we are #1 in Europe in terms of size. Beyond that, we operate out of 12 offices in 19 countries. Recently, as you've read and as Logan alluded to, we were acquired. Transaction hasn't closed yet, but we've been acquired by CIC, China Investment Corporation, which invests China's foreign exchange reserves. We're very excited about the next phase of Logicor, what I call Logicor 2.0. So stay tuned.
Great, thank you, Robert.
Robert Dobrzycki, I'm CEO of Panattoni Europe. Panattoni Europe is a global private development company doing logistic industrial. In Europe, we are present in Germany, Poland, Czech Republic, Slovakia, Romania, and we just recently entered UK, forming a JV with First Industrial, so plan to expand there. We are privately owned, we are a development company, and we are one of the most active development companies in Europe.
Great, thank you, Ben. Apparently, I'd like to add currently to Mo is currently #1 maybe, or you'll argue, I don't know.
Well, I'm always wondering how 14 million is bigger than 17 million, but clearly it is. Anyway, we don't want to be the biggest, just the best, Mo, so it's okay. So my name is Ben Bannatyne. I'm responsible for Prologis in Europe. We're in 12 countries across Europe. We have 17 million, well, just under 17 million square meters, which we own and manage and look after. I'm based in Amsterdam.
Great. Let's start with you, Ben. Last year, very interesting discussion here. 12 months later, what do you see as the kind of maybe the biggest changes that you've seen in the market over the last 12 months, and anybody else pick that up as well afterwards? Ben?
I think from our point of view, 2 key things. Well, one which hasn't really affected us, but certainly the amount of Asian capital that's come into European logistics in the last 12 months. And one that does affect us is certainly the high levels of occupancy. So we are now, I think it's about 96.5% leased across our whole portfolio. And I think we have 4 or 5 countries which are effectively 100% occupied. So we were maybe 100 basis points off that last year. And we thought last year would be, well, last year was our best year. However, it looks like this year will surpass that in terms of occupancy. And I think that goes for all 12 countries that we're present in.
Okay, so that is quite a significant change, actually, and particularly over 2 years ago, when we had this discussion, the occupancy levels have changed quite significantly, haven't they?
Correct. So I think 2 years ago we would have been in the low 90s and probably actually in the high 80s in a number of those countries. So it is over a portfolio of whatever 17 million square meters. There's a big volume of leasing that's been done. And also due just to the shorter term nature of leases in logistics, about a third of our portfolio is churning every year. So to keep those levels up at sort of 96.5% is challenging, but that's why we have a good team on the ground in every market where we operate.
Okay, good. And is everybody else seeing that in terms of occupancy? Is that different in different markets?
Certainly for us, we're also at 96.5%, and so I reflect a lot of things that Ben said. I think that the occupancy level is continuing. I think the oversupply we had back in the 2000s, all of us learned a lesson, and that hasn't happened, and therefore there isn't the same spec space being built and let. I think we're all building a bit of spec, certainly we are, but that means that you're able to keep the occupancy levels up. It also allows us to see rental growth in many countries. And we, like Ben, we're 100% in several countries.
So there's definitely a trend across Europe in that sense. Yeah, Mo.
Yeah, I think clearly supply has been in check. We talked about supply and not having it run out of control last year. But my observation is in most core markets, there is really a lack of availability of good functional modern space. That's why you see some of the developers actively developing. So it's really, we're talking about low single digit vacancy in most core markets. And in many markets, if you want 35,000 meters, there's no availability. So the fundamentals are very, very strong in the sector right now. And that's a precursor to rental growth that we've seen in many markets and will continue to see in others.
I just wanted to pick up, let's say for the last 12 months, a lot of the discussions that we've been having have kind of focused on risk in the market, whether that's political risk or political shocks from Brexit and various others. But the logistics sector seems to have been completely divorced from any of these risks. It doesn't seem to have had any impact at all. Is it risk-free in that sense, Robert? What's your thought? I mean, for example, Brexit may have put off a number of people from the UK, but you've selected to enter the UK at this point. So are the fundamentals of the market strong enough that actually those transient risks perhaps become less relevant?
Well, obviously, for a few years already, kind of we see a huge run on logistics, and demand-wise, it's a kind of an amazing sector. Obviously, it's so hot. Also, it's very hot also on the capital side. So we felt like Brexit could be kind of a bit of opportunity for us to come to UK, which was a very tight market so far. So we felt that's the right moment for us to go. Before we were thinking about it, but it was never right set, kind of business set. Locally, we couldn't kind of make kind of our thought process kind of to stand behind the numbers there and how to access the market. But currently we saw that Brexit might be an opportunity to go to UK, and that was the idea. But also what I think from our business standpoint, what changed the most during the last 12 months is kind of we started to see construction costs going up everywhere, which means that probably with the yields compression slowing down, it means probably in some places, or almost all places, rental growth potentially, because you can't build new product cheaper than the old one. So that's what we'll see soon. So that's the biggest change I see.
Okay, and Ben, I mean, obviously there's therefore a lot of current demand for space with occupation level, that kind of level. Does that mean that therefore there's got to be a lot of development? Does that mean that if you're sitting on land, you're going to now develop that? Is it speculative development? Is that coming back into the market?
So whilst I think we've all said that supply has been limited, it doesn't mean there hasn't been any development. There's actually been a huge volume of development done right across Europe. The difference is, for example, for our portfolio, I think this year we will develop somewhere around 700 million euros worth of new warehouses. 60% of that will be build to suit, so no new supply coming onto the market in terms of vacancy. 40% is speculative, but of the 40% that's speculative, probably 50% of that is pre-leased. And the other 50% is normally leased before the building's completed. So there is lots of new supply coming onto the market, it's just not vacant supply. And the 20%, I think, of our new leases have been driven by e-commerce or some kind of e-commerce related activity, which means the other 80% is our traditional customer base that are expanding, either within existing parks or new locations. So actually demand right across the sector still remains strong, and on top you have the benefit of the e-commerce play.
Okay, and that's an interesting point. Ian, just in terms of, because obviously I'm not sure what component e-commerce is in terms of your portfolio, in terms of your work, whether it's 80-20 or more than that, but are you seeing similar growth in terms of, because there's beginning to be a story of positive economic situation. Are you seeing that boosting the traditional manufacturing side as well as the e-commerce? Ben, what's your sense of it?
Yeah, I think that demand at the moment is, everyone talks about e-commerce, but it's not the largest part of our business, and we're under 30% in e-commerce, but you have to understand a lot of warehouses, traditional warehouses, a part of it is being used for e-commerce, rather than, it's not an Amazon, but there are people who are using a part of the warehouses for e-commerce. And so do you count that as an e-commerce in your percentage? So it's around that sort of 20 to 30%, depending how you look at it. I think on the demand, we've started some big buildings speculatively where we see a huge shortage in the market. So in Bucharest last year, we built a 58,000 square meter building completely spec, and it was completely let before we'd finished it. And one of the great things with spec buildings over traditional build-to-suits is with a build-to-suit, you have a tenant who's driving you down to the lowest rent to the point where you're making profit, you're happy. When you do spec, and there's even off plan, you're able to set higher rents. So there's almost a two-tier market between the two. And obviously valuation-wise, if you can show a market has a higher rent, then that's great. That means your valuation of the build-to-suit you did, it's reversionary and therefore it's worth more. We're continuing to do some spec. We normally do it as a part of a build-to-suit, but in Germany at the moment we're just starting one building of 40,000, another of 30,000, again completely spec. Interest is very strong, and the fact you have 96%, 17 million square meters, they have a 96.5. Sorry, Ben, I forgot the 0.5 is occupied. And we have the similar things. I'm sure Mo's very similar. Means if you want new space, it's not there. You have to have build-to-suits, and I think that's the second thing we're seeing is in some locations, it's not possible to buy land anymore. So we've actually this year knocked down 2 of our old warehouses and built 2 new ones in their place. One was 50,000 square meters in Bedburg in Germany for Nex, and one for in Lom in France. And we're doing that again. We have a very big building in Carmen. It's nearly 1 million square meters. We're going to knock it down and create a new park. And that's caused by this lack of availability of supply. And I think this is another thing that's driving, 2 things driving new locations. One is the people who can work in them, and second is availability. And that's going to be a challenge for us.
And that's interesting, the point about, we've been doing sessions on cities and investment and human capital, and actually be able to have the workforce there was one of the things that was coming up as a key issue generally for investment and investment-ready cities. Mo, is that one of the things which might previously have been regarded as a bit of a soft investment topic, but actually finding locations that have the right workforce? Is that key to some of the location decisions you're making?
We don't have as an active development program as some of the other panelists here, but clearly we've developed probably around 200,000 square meters in the last 2 years, either through a build-to-suit activity, redevelopment, or a couple of spec developments. But clearly, from our point of view, location is an important driver of our investment decisions, and for occupiers, clearly, particularly for some of the more recent, larger e-fulfillment requirements. They're very labor hungry, Robert can probably talk about his experiences in Poland, in particular around labor, lack of labor, and how occupiers are really looking at locations where labor can be brought in cases we've heard of labor being imported from Vietnam into Poland to accommodate some of the operations. So labor is really, really an important factor going forward. Today, looking forward 10, 15 years, what's the impact of automation on labor count? Do we need as many workers in these large e-fulfillment centers, or will robotics be a counterbalance?
Let's pick that up, Robert. So it's an enormous commute from Vietnam. I assume it's not on a daily basis. Even for the logistics world, that would be a challenge. But let's pick that point up. What are you seeing today, and also what are you building into your strategies for the future, whether that's robotics or automated processes that maybe mean that you have less people actually in the facility?
Yeah, absolutely. I do agree that labor currently, mainly because of kind of a change of the use, which, I mean, in new build is mostly e-commerce type of a use, which is much more labor intensive. The labor is the main driver of the location. So obviously it is changing our thought process. We try to follow the customer, and obviously we need to follow the labor, which is kind of changing the landscape a bit too, because the core markets which we saw before might be not the core markets of the future because of the labor. So we are starting to develop in locations which are maybe a bit more emerging, but kind of a very deep labor-wise. And we feel like there is a really strong interest from occupiers there, and we don't have any competition, which is kind of obviously good too.
Okay, good. Ben, did you want to pick that up?
Yeah, no, we have a customer advisory board twice a year. We have, I think, 15 customers we sit with all day and discuss what they're seeing in their respective businesses, which covers all our customer base, basically. So from the 3PLs, the retailers, etc. And each one of them said the top 2 issues that they are facing or worried about going forward for the next 2, 3, 4, 5 years is people, so availability of labor, but also qualified labor, not just blue-collar workers, and power. And actually, power started to go to the top of a number of people's lists in terms of if everything goes the way we believe it will, in terms of automation and robotics and electric vehicles, etc. Will we have enough power to run not only all the kit they have inside their warehouse, but all the electric forklift trucks, electric cars, etc. So I think power is going to be one of the major things that we have to think about in terms of location, which kind of takes us back to our strategy for both people and power to be near the biggest population centres, across Europe. So slightly different from Robert's. We're a long-term owner. We want, I think, sustainable development in terms of long-term development. So we're really focused on the main population centres in each of the markets that we're in.
Okay, good. Ian, you wanted to pick that up?
Yeah, I think one of the things that we need to look at, I agree totally on the power thing, is whether there could be a future where in certain countries your roof is covered with voltaic panels, not to put back into the grid, but to put into the Tesla batteries that you hold in the warehouse, and the Tesla batteries then provide a lot of the power to run the whole building. I mean, the technology is getting better and better, and if that's something, maybe it's 3, 5, 10 years, but I can see it happening in the future. That the warehouse is the power plant for itself.
And just picking up on some of those technological things, Ian, there's obviously, we had a good session yesterday on e-commerce, and Dirk, actually, your colleague in research, was giving some information about what was happening in terms of supply chains in the States, what might come through. And we had a kind of view on just kind of a highlight, really, of some of the technologies that there could be, but the drones, whether it was electric vehicles, self-driverless electric vans, whatever it might be. And so I'm going to put this into a category of called Don't Believe the Hype. Partly because it's difficult to get a Public Enemy song into one of these sessions, but and I knew you would enjoy that. But also, how many of these things do we actually think are going to happen? I mean, there's been talk about drones for ages, but is that really a practical solution? Are some of those technologies things where you just don't see that actually coming into reality?
I used to laugh at the thought of drones. And then I found out just how much work is going into it, and Amazon and the likes, and stuff that's happening in the UK, Cardington near Bedford, where these big drones to hold goods to be then flown down are actually being trialed, which shocked the life out of me. I still personally can't see how you can have in any sort of city, drones flying around. At the moment, the batteries on the drones mean you can deliver about 2 kilometers if you're lucky. But that doesn't mean for the future it won't happen. So that to me is not hype completely, but a bit fantasy. I think driverless vehicles and cars, etc., are the future. Whether that's lorries or cars. A statistic I read the other day was that in the States there are 44,000 people die every year in car accidents. They've done the calculations, if they were driverless cars, that would drop to 4,000. Most of that's alcohol related. Yet people are scared about having a driverless car. That the proof is there. It's just we think we're cleverer than robots, and we're not. That's a bit frightening. Well, maybe not in my case, it's probably obvious. But it's a bit frightening. But once we get to accept it, I think certainly in the next 5-10 years, we're going to see changes we almost can't even think about.
Yeah.
Well, I don't know if anyone saw the picture of the Dubai flying taxi, but it was basically a drone that you sat in and it flew you somewhere. So I would not be comfortable sitting in that. But drones we use, I think drones are extremely useful. I'm not sure they will be used, as Ian said, to be delivering stuff around city centres. But in terms of just helping your day-to-day business, we're using them for security. We're using them for doing roof, maintenance checks. So it is a new technology which is replacing manpower. So they are extremely useful, but I'm not sure how disruptive they will be in terms of the actual business of logistics.
Okay, good. I wanted to drill down a little bit into some of the investment topics. I'd actually written as one of my questions earlier, which was about yields and pricing. Would we see changes? And actually, there's been a deal this week, I think, where we're now looking at 4.25 as a yield, which sets a new benchmark. Mo, maybe how do you see that progressing? Do you think yields will just continue to go down now that that's reached do you think they can go down beyond that? What's your view on it?
A year ago, we had the same discussion. Where do we think yields are going? And I think the panel, by consensus, predicted at least 50 bips compression in October of 16. A year later, I'd say maybe we've gone down 75 bips, if not more, on the prime end. There is a tremendous amount of capital wanting to get into this space, and you have to look at what are the alternative places where this capital can go. You have to look at the asset class. What are the inherent risks and rewards of owning this asset? I think it's proven that is highly resilient throughout the cycles. If you look at occupancy rates in major REITs or real estate operating companies at the depth of the recession compared to some of the office, retail, and other asset classes, the dip was a lot less. If you look at recurring capital expenditures to maintain this asset class throughout the cycles as percentage of NOI is among the lowest. You have to spend the least amount on TIs and CapEx on this asset class. And you look at alternatives. If you look at retail, for example, if you look at yield spreads between prime retail and prime industrial today, it ranges from a low of maybe 75 bips in UK, where prime retail is probably around 4, prime industrial 475, arguably lower now after this 4.25 quote. And in some other markets, you're at 125 bips, 150 bips. Germany is 100, France is 125, Belgium is more than 200 basis point. So with the structural tailwinds we see in the industrial asset class helping it, many see them as headwinds for retail. So should there be this much yield differential between prime industrial and prime retail? So if you look at it from that perspective, I think there's room for further yield compression. If you look at where all-in financing costs are today, swap rates 25 bips, 5-year money all in, you can get it at 2%, low 2% for, prime logistics, good location. So in that context, you're still getting really good cash on cash returns, at least for the next 5 years. You have to take a view on where rates are going to go. But clearly against the backdrop of alternatives, cost of capital on the debt in particular, the structural tailwinds we see on the demand side, e-commerce, everything else, I don't think we're at top of the market. And certainly, yields may have room to go. And certainly, if we don't see a lot more yield compression because of increasing cost of construction, very, very low vacancy rates, we're going to see rental rate increases. So I think this is still a fantastic asset class to be in.
Ben, you...
Yeah, no, just to follow on from Mo's comment, I think the cap rate compression, it's definitely slowing down, but there's still a bit to go. But it's really a play on what you believe is going to happen with rents. And I think there is a feeling that rental growth has finally started to come across the continent. So the UK, we've had double-digit rental growth for the last 18, 24 months. That is continuing, despite Brexit, etc. We are starting to see it in some of the tighter markets in Europe or on the continent. So if you do truly believe that rental growth is coming, I think we will see further cap rate compression. But you have to be extremely careful, like any real estate, about location. And I think, a rising tide lifts all boats. But what will be very interesting during the next downturn, as and when it comes, what locations prove to be resilient and keep their occupancies, 90% plus, and which locations end up like they did in 2007, 2008, being at 50%. So for me, the cap rate is interesting, but it's really all down to, at the end of the day, location, quality. And I would still be extremely careful buying, particularly in this market today, in terms of the locations that we were focusing on.
Okay, good. Robert, I wanted to pick up one thing with you in terms of, often it's just viewed as it is a shed, and so therefore there's no capex, really, nothing to be done.
You should be aware that most people here wouldn't know what a shed is. It's an English term.
Is it? Okay,
so when I tell people I'm a shed head, they go, he's got a garden shed? It's an English term for a warehouse.
Yeah. If you've got increasing demand from occupiers, maybe for different, more complicated solutions for them, does that mean that there's a potential for you having to do significant capex as it goes on, that because automation may increase, and probably if it does, it's going to increase at quite a dramatic rate? Do you think that leaves there a chance of there being a problem in terms of that, and you having to put more capex into these sites?
Well, I think the main issue right now is that we see the fundamental change of the use. E-commerce is starting to be a main use. It's going to be a main use going forward. That's pretty obvious. And obviously for e-commerce, that's a different type of operation. It's much more labor intensive. So obviously there is a capex linked with labor. So obviously natural light, air conditioning, parking spaces. But also e-commerce is forcing kind of a new use in terms of height. We were saying in the past height of 10 meters to be a kind of a standard clear height. Sounds like it's not kind of like the best for e-commerce right now. We see 12, 15, 18 meters kind of buildings. And I think that's the fundamental change right now, specification-wise, height. And also when you look at the site and at the master plan, obviously one thing is a location close to the population, labor kind of a proximity. But the second thing is the height. Is the height in the master plan. How high you can go up. And I think the future warehouse, e-commerce warehouse, would be up to 20 meters high. Obviously, regular storage is not efficient, but e-commerce buildings would be just higher.
So yeah, I think for probably one of the biggest changes, as Robert said, over the next, I don't know whether it's 2 years or 5 years, but will be this idea of multi-level or multi-story. And not multi-story in the traditional sense that you see in Asia with ramps going up in seven levels, but multi-story with ground floor docks and internal. So effectively, permanent mezzanine levels, but floors. And the challenge around that is traditionally we are a square meter based business. It's all on the ground floor. Once you start charging rent on ground floor, first floor, second floor, and you capitalize that, you get to massive capital values per square meter. And it probably is the way forward, but it's a big leap of faith today, knowing that in 10, 15 years' time, 3-level or 4-level warehouse is going to work that way. So I think that's where certainly we and a number of investors will be grappling with. It definitely is the future, but it's a big bet that you start going multi-story and leasing every floor as a separate, effectively a separate warehouse. So I think it's going to be very interesting to see how that pans out over the coming years.
Yeah, and I 25 years ago, I think, I was the chairman of the Industrial Agents Society, which is called the Shedheads in England. And at the time, we were trying to promote the idea of cubic rent rather than rent per square meter, because often you'll have a 10 meter, or in those days it was 6 meter. 6 meter was good, 8 meter was extreme. Now we're up to, as Robert said, the norm, certainly for us, is 12. And therefore, if you've got an occupier who actually is going to use the space, then there should be a cubic capacity, I would suggest, rather than a rent per square meter. It's very hard to educate, but it's what, at the end of the day, what a warehouse is about. It's what you put in it. You then have the interesting debate, which we've had with ourselves, is if it's an industrial user who only uses the lower section of the building, then how do you do that on a cubic capacity? So it's interesting, but there is a debate to be had, and whether it's multi-level or height, somehow these things need to be reflected.
Yeah. I think as a follow-up to that, if I may, up to this point, we've accommodated most of the fulfillment requirements for multi-story through non-structural steel mezzanine built within the shell. Now, occupiers like Amazon, who are leading really the thought leaders in terms of development of these multi-story facilities, are asking for structural. So this is a bet that we as investors, owners, developers need to make, that this will indeed be the future. Obviously, there's an element of trust us. We know what we're doing, but it's not yet a proven product. It's not a proven market. But again, we thought the same thing about cross-docking. 15 years ago, cross-dock was a very bespoke and relatively unknown specialty product within logistics. 5 years ago, very few people invested in the asset class. I think today we see it becoming increasingly accepted as an asset class because there's a convergence of design and thought around how these facilities should be laid out and how they should work. And from an investor, developer, owner perspective, we are feeling increasingly comfortable that there is longevity in future. So in the multi-story, that's still a bit of an unknown area, one that we would have to hold hands together with occupiers, experiment, and go forward. But clearly, that's one area where the industry is going to be affected, especially as land becomes more scarce, use has to become more intensive. So whether it's internal conveyor system feeding e-commerce activity within the building, or even multi-story, like what we've seen in Asia, being developed around major urban areas in Europe.
I mean, that's interesting, because it would be good to pick up. I'm going to come for questions in a minute, so please do, I'll ask first, so think of them, and I'll be with you in just 1 second, which is, if you've got, I mean, there are growing trends around the world generally, but in Europe particularly as well, on urbanization, more people moving into cities. You've then got that combined with Amazon doing same-day delivery, various others, the e-commerce and the desire for more convenience, meaning that it's very difficult to shut that door again when you've offered that kind of same-day delivery. And we heard yesterday in e-commerce about the potential growth just here in Germany, if you compare it to where we are in the UK and things like that. So does that mean that you're going to have to look at inner city urban logistics, or will it be out of town? Will they be priced differently? And does that mean that people should be buying now light industrial areas, because they are probably, there's quite a big yield differential between them and logistics?
Yeah, I mean, we're already into that market. And the debate we had, are we a big box company or are we a company that actually will follow our customers from the top, a vertical, down to the bottom? And we bought a site in Czech Republic, Horní Počinice, and a lot of the distribution there is what we'd all now call urban logistics, because it's within 10-15 minutes of Prague city centre. Elsewhere, we're looking at other sites, and it's quite interesting. You have two or three things. You have, one, a need for sites in the centre where you're going to be fighting against residential, as city centres go. Secondly, there's the need and you talked about one-day delivery from Amazon. I think in New York, I'm right in saying it's 1 hour. So if you're going to be doing 1 hour delivery or even a few hours, you've got to have a distribution that are very close by. It's actually not only just a parcel distribution, it's actually holding some key lines of items. So you put that together, you've then got, if you're trying to find a site that's used for this last mile, it's probably already being used as something else. There aren't greenfield sites. So this is a sort of re-looking at how you take the old, turn it into the new, or maybe just convert it. And that again then leads to noise issues. Could you have last mile distribution underneath a residential building? Or could they go in the car parks? We had a conversation with a very big office developer in Czech Republic who was querying us about, could they put in one level of last mile distribution below the office building and then 2 more floors beneath that of car parking. Normally there'd just been 2 levels. They're saying let's get down 3 levels and create an urban logistics platform, because it doesn't need the height. And that's some of the things that we're having to look at, and I say we're actually already in the market buying sites.
So I was not convinced at all of the need for 1 hour delivery. To me, it just didn't make any sense. However, my 6-year-old son was on the laptop. He ordered something on Amazon. He shut the laptop and he went to the front door and opened the post box. And I said, "What are you doing?" He's going, "I'm checking to see if it's here." And I said, "You just ordered it." So clearly the younger generation have a very different anticipation of what speedy delivery means. So I think urban logistics very much will be something that we will all have to focus on. The challenge is, what is it? Is it a mix of residential? Is it an underground garage? Is it just people going to work with an app and they pick something up on their way home and deliver it to you? I mean, there's so many different things being looked at the moment. It's extremely difficult to know which innovation will end up leading, and therefore where would you invest at the moment.
And obviously, as a father, it's only right and proper to immediately start blunting that sort of optimism. Sooner he learns better. Let's take questions. So if anybody's got a question, please put their hands up. Oh, you're all very shy and retiring, aren't you?
No, it's almost 4.
Any
and
questions?
They want to go for a drink.
It's drinks time. Okay, very good. Let's try and put some predictions in for next year when we have the session next year. Biggest prediction, and so one prediction from each of you, and maybe let's look at which locations people should be looking at, locations or asset types that you think will outperform over this year. Let's start with you, Ian.
I think Mo mentioned yield compression. I still think there's yield compression to come, maybe 0.25% Western Europe, and probably some of the, as further east you go, maybe 1 or 2%, somewhere like Romania, as you come in. So I think there's other places in Europe where you can certainly see yield compression happening. And we mustn't all forget that obviously Gaisley was announced the sale to GLP at 2.4 billion. Most of us could sort of get a value up towards 2 billion, but couldn't reach 2.4. And they had 3 bidders within a very small number. So that weight of money that was spoken about earlier is there. Huge amount of weight of money. And so I think that's going to drive yield compression. As for the countries, we as P3, I mean, every single country is performing well. It's easier to get your returns slightly further east than it is to the west. And we don't have to do deals. We're long-term patient capital with GIC, so we can afford to wait in some of those markets until maybe there is a recession, or certainly a dip or an adjustment, whatever you want to say. But I can't see that happening in the next 3 years at the moment.
Okay, Mo.
As I said earlier, I think fundamentals are really good in the industry. With our pending change of ownership, I think we're going to continue to focus on internal growth opportunities within the portfolio, driving occupancy and driving rents. We do believe rental growth is coming in some of the countries. We've seen a very strong rental growth in UK. We've seen it in Germany. We've seen it in Barcelona region, and we're starting to see it in a number of other infill urban areas. So I think that is there. Obviously, the opportunity to acquire large portfolios at deep discount to replacement cost is no longer around, and you can see the pricing for recent transactions. There's definitely a premium being paid for platforms, and clearly, the question is, how do you translate that into asset level valuation and portfolio premiums? Conversation that Ben and I were having the other day. But invariably, there is a tremendous amount of demand. I think fundamentals are good. Customer demand is robust. The supply side is very much under control. 10 years ago, in the last, prior to the last peak, 70% of deliveries were spec. Today, probably 25 to 30% are spec. So there's a lot of discipline there. Construction financing is really not available to the local players. It's really real estate operating companies with balance sheets that can develop on a spec basis. So I think that's keeping a lot of control on the market. So, been in this industry for about 30 years and very optimistic. It's probably the healthiest fundamentals I've seen in my career. So I think we're in a good spot. Of course, there's potential geopolitical shocks out there that could affect the industry. Brexit, depending on how it happens, could have an impact on UK. Now we have the Catalonia secession. What does that mean for Southern Europe? Does it trigger other stuff? What's happening in Korea? Those are things outside our control. They don't keep me up at night. I focus on what I can control.
Okay, good. Robert.
Yeah, I think for the next 12 months, probably what we would see is, as discussed, construction costs going up, land costs going up, we would see continued kind of a yield compression. Also, we would see even stronger demand from e-commerce everywhere in Europe, which obviously will put another kind of a pressure on rents. So overall, it's going to be a bit different market than so far. So far, only kind of a selective markets we're seeing construction costs rise or kind of rental increases. Looks like because of the construction cost and land cost, it has to happen everywhere because you can't build cheaper than before. So I think that's what will happen. Location-wise, we still believe that western part of Central Europe, Southern Europe, would be the strongest market going forward for years because of fundamentals of labor cost and location.
Okay, good, Ben. One thing I just wanted to pick up as well is, because I'd forgotten it, which is the kind of Silk Road, that new logistics link from bringing things directly from China into Europe. Does that also have an impact on locations and the attractiveness of those? Will there be a big impact from that?
We've actually done a lot of work with the Chinese authorities in this, with our team in China. And clearly it will have a massive impact at some point, but again, not quite sure when. But interestingly, I mean, you are seeing all these big platform deals have been with Asian money. They're actually buying individual logistics assets as well. So we just sold a big park in Slovakia to a Chinese investor. And I'm convinced this is all to do with exactly what you are talking about in terms of this new Silk Road. So I think it will have a big impact, but I don't think it's something that we will be talking about again next year, having suddenly transformed logistics flows, etc. In terms of what we will see, I think the next 12 months is going to be extremely strong again. I'm convinced we will see double-digit rental growth in most of the core markets across Europe, finally. And although there are no platforms really left to buy, I think with all the Asian money that's come in, there will be some further consolidation. So not quite sure how, but I'm pretty sure we'll see some of these platforms combined or something. We'll see.